Welcome, and thank you for joining us today. I'm Allison Berger, one of the financial advisors and partners here at Financial Symmetry. I'm joining you from our office here in Raleigh, North Carolina. And as you've probably noticed, it's election season. And we're hearing from a lot of clients that they are particularly concerned this year. So we're really looking forward to hearing from our speaker today, Christian Newton, on the investment implications of the current election. Before we get started, and while we're waiting for everyone to join, I just want to go over a few housekeeping items. You can see and hear us, but we cannot see or hear you. There is a Q&A box at the bottom of the screen that will allow you to type in any questions that you may have. We will address as many questions as we can today, but if we do not get to your question, we will follow up with you this week. No one will be able to see the questions that you submit. These questions are private, and only the hosts will be able to view them. Dimensional Fund Advisors is one of the preferred mutual fund companies that Financial Symmetry has hand-selected for your investments. As fiduciaries and independent advisors, it is important to note that we do not receive any commissions or kickbacks from DFA. Likewise, we do not pay them anything to be a preferred provider. All that being said, I would like to introduce you to our speaker today, Christian Newton. Christian is a vice president and regional director at Dimensional Fund Advisors. He helps financial advisors leverage Dimensional's capital markets research and its application to portfolio and practice management. He presents regularly at industry conferences. He holds a BA in history from the University of Massachusetts at Amherst. His online writing has been profiled in the New York Times and Entertainment Weekly. He lives with his wife and son in Charlotte, North Carolina, which is where I grew up as well. Christian, thank you so much for joining us today.
Thanks, Allison. Thanks for the opportunity to spend some time with you. And thank you everybody for probably spending the lunch hour with me. Like Allison said, I know probably for all of you, the election is top of mind. So what I want to do in just about 30 minutes is to share with you a lot of econometric evidence from Dimensional on how markets have tended to perform during, before, and after elections. I want to answer a really simple question. Are there signals in the movement of markets that we as investors should be taking advantage of? That's what I want to spend the bulk of my time examining with you. But I want to reserve a lot of time outside of my presentation, certainly to take any questions that you may have, questions about the evidence that I present, questions about what's happening in the world, questions about the elections. To the degree that I can answer those, I will give it my level best. But I also want to do one more thing. As I hit my conclusion, I also want to share some social science evidence, not about how markets work, but about how our brain works. I think so much about how we kind of receive and experience election seasons, especially through the lens of how we think about our wealth, how we think about our investments. We can learn a little bit about ourselves by looking at some of this evidence, because at the end of the day, I think that all of us as investors have a really powerful choice. We can choose to respond to some of these signals that we get either in the market or in the media, but we also have a choice not to respond. We have a choice to use the investment plan we've established. And I want to kind of outline, I think, the power of that choice. So with that, I want to get underway. So a couple of housekeeping items. Number one, if it's not already obvious, even though we are talking about politics and elections, it is not my goal this afternoon to revise your political opinions. We don't have that kind of time. That's probably not the experience you want. Instead, what I would like to do is I want to encourage you to reconsider and possibly more strongly separate your political engagement, your political opinions, versus how you think about your total wealth, and specifically how you think about your investment wealth. And we'll return to that idea later, but that's what I really want you to do, is consider how, if at all, you combine these two domains in how you think and how you act when it comes to your investments. Now, I want to start actually just as kind of a fun warm-up, if we can do it, with a poll. Now, it is kind of polling season, whether we like it or not. Don't worry, I'm not asking you who you're voting for in the election. Instead, I'm curious about your perspective. especially your emotional perspective about what we're all experiencing right now. So you see the questions up in front of you, 3 just binary yes or no questions, very straightforward. First of all, are you looking forward to this period? Of course, we're right in the middle of it now. The election season, the kind of the most feverish part of certainly an election year, right up until the election. Are you enjoying that experience? Yes or no? Secondly, after the election, are you expecting the result to be good? And by that, I mean good for you, however you define it. That may be politically, that may be culturally, that may be economically. Are you expecting a good result as you define it? And finally, are you expecting your investment returns to weaken following the election, yes or no? I can't vote, but I'm hoping all of you do choose to vote. And I want to take a look at all the data with you to get us started. So hopefully everyone's had a chance to participate if they wish to. And we could take a look at the results here, really fast results. Okay, excellent. Thank you so many of you for participating. Well, let's break down what we see. Are you looking forward to the election season? And I've asked this poll of many folks in the past couple of months, and this is the same trend I see everywhere else. You are not looking forward to that period. You're actually not enjoying election season. That's something that we're going to focus on. I think there's a powerful reason, maybe more than one powerful reason why. Second question, are you expecting the result to be good? And to me, that's just everyone I'm talking to today. Are you pessimistically or optimistically looking forward to the election being over? And most of you are looking forward to a positive result. And I'm glad to hear that. I guess on balance, I'd prefer to speak to a bunch of optimists than pessimists. And then finally, are you expecting your investment returns to weaken following the election? And the vast majority of you, 70%, say no. I am also really heartened to see that result. And I'll share with you that most of the time, that's not the result I get. Usually it's dead down the middle. About 50% of the audience I present to, and these are audiences around the United States, are just as many are expecting weaker returns going forward as stronger or sustained returns. So thank you very much for sharing that with me. I just want to get a little picture of where you are all coming from as we talk about what's happened in markets. But again, I think just as important, what's happening in our brains when these 2 really important domains, political engagement, democracy, if you will, and investing, maybe I'll redefine that as capitalism. When we put those 2 things together, what happens? And I actually want to start by reflecting on both democracy and capitalism, because I think they have one really powerful thing in common. Now, if we look at kind of political history, they do not require each other. We can certainly find democracies that do not have strong capitalist traditions. In turn, we can also today easily find countries that have pretty strong capital activity, but are not democratically inclined. Despite that range of experiences, I actually think that democracy and capitalism go really well together, like peanut butter and jelly. But I think there is something psychological that's challenging about both. And the fact that they have this in common, I do not think is a coincidence. What is challenging about both? Well, I think on some level, they're both messy processes. What do I mean by that? Well, if we think about investing, capital markets can feel really messy. They can feel chaotic. It can feel like no one is in charge of where the stock market or the bond market should be. And I think that feeling is accurate. In fact, I would argue that no one is in charge. No one determines, no one fully controls the value of the stock market, that ongoing auction of the value of every share of every company that's publicly listed, either in the United States or around the world. No one investor, no one government, no one central bank, no one Congress, no one president, I want to argue, controls or influences the stock market, especially over long periods of time. We will reflect on that later. But the result is that it does feel messy, and that messiness can lead to a sense of stress or anxiety because, in fact, there is no one in full control. I think we can say the same thing about democracy. On some level, of course, we have political parties, we have traditions there. We certainly have a federal constitution and state constitutions that kind of set up the guidelines and the rules for elections. But on a really material level, no one person, no one party, no one body controls who runs, who is successful, and who is elected for president or Senate or Congress. It too is a very messy set of circumstances. So these two have a thing in common. They have one more thing in common, a famous quotation that I think applies to both. And I want to share that with you here. This is Winston Churchill, 1947, following World War II, making an address to Parliament. No one pretends that democracy is perfect or all wise. Indeed, it has been said that democracy is the worst form of government, except for all those other forms of government that have been tried from time to time. And I feel like in Churchill's incredibly eloquent and British way, he's suggesting, again, democracy is messy. It sometimes disappoints us, but it appears to be the best way to govern large bodies of people in a successful way. Maybe put it more economically, the best way to allocate resources in a successful way. Now, the second reason I share this quotation with you is that it has often been revised and incorrectly published, where people have removed democracy and they have put in capitalism. No one pretends that capitalism is perfect or all wise, but indeed the shorthand goes, it's the best, worst system we've got. Again, what is it? It's a really messy, we could say maybe really dynamic way of allocating resources. Capital moves very, very quickly. And if we are investors, if we in fact take on that role as capitalists, that can strongly benefit us. So the negative way to think about it is that this is messy stuff. But to me, the positive way to think about it is that they are both dynamic. They both respond to pressure. They both respond to forces in society. So both capital markets and democratic activity, I think in the long haul, do benefit us as citizens and as investors. And I hope I leave you with that kind of positive perspective, despite the fact that especially in election years, I think the kind of the sum total of all of that activity creates a lot of stress and a lot of anxiety for us as investors. All right, so that's my introduction. I do want to get into a few nuts and bolts here to get us started. Really basic perspective, basic historical econometrics, looking at market returns data. What party does a better job for capital investors, Republicans or Democrats? Of course, there have been a lot of parties over the years, but in the last 100 years or so, those have been the strongest parties, certainly in the United States. Is there a obviously better party for investors if we look into the historical data? Let's take a look at that now. What I'm sharing with you here, I believe, is the biggest, in a sense, widest angle lens view I can give you of the experience as a public market capital investor. So we're looking at the S&P 500 index, which is an index that's been worked back to 1926. So this is all independent index data, running that forward to the end of last year, right to the beginning of 2020. And of course, before I bring in all of that politics and all the control and the red states and the blue states and all that, I would hope that what you take away here is there is, in the long term, in fact, the more time I give it, the more positive result I should expect as a capital investor. I can see very strongly in terms of the growth of a dollar what that capital can do if I give it time. Now, that does not mean it is always a smooth path. Of course, we can look into the Great Depression, very obvious to see here. We can look at the dot-com bubble, 2008 and 2009. They present themselves pretty strongly as times where we have really significant challenges to our returns. But over the long haul, there is a positive return for capital investors. So let me bring in control of the White House and see if there's a really strong pattern in all of those up and down lines. So I'm going to bring in control of the White House going all the way back to 1926 and going forward. And it looks pretty even-handed, and in fact it is. There is not a very strong, very dramatic difference between the sum total return for the Republicans or the Democrats. It's pretty close. But if you're asking me who has the better edge, at least up until the end of 2019, it is the Democrats. Now, why is that? Well, part of it probably is because the only absolute return negative administrations happen to all be Republican administrations. And I want to take a look at that a little more carefully. So here we're looking at all of the presidential elections from Hoover going forward. And you can see two of those three administrations that I was talking about. The Hoover administration, of course, dramatically negative because, of course, Hoover presided over the beginning of the Great Depression. Now, I don't think most people would subscribe all of the responsibility for the Great Depression, certainly a complex state of affairs, to the Hoover administration, but that is the presiding president at that time. And I would say a similar state of affairs exists with Bush 43, George W. Bush, again, coming into office after very strong markets under Clinton, but just has the bad timing of really encountering three very strong negative events: the dot-com bubble bursting in 2000, certainly September 11th, 2008, and 2009, the global market crisis. Most of those down months on Bush's ledger. But again, I think it would be difficult to argue that Bush policies exclusively and alone led to all of that negative result. I don't think most reasonable people would make that argument. After all, I want to argue, central to my argument, the sum total of the economy, the sum total of the GDP, the sum total of the capital market, which sort of sits on top of all of those forces, I want to argue is way bigger than what any president or any Congress can directly control. There are so many other forces at work. Certainly political activity, I would say, influences the impulse for growth and for investment and for success, but it is only influenced, it is not controlled. Now, I said there were three administrations that had negative returns. The other is the Nixon administration. And in fact, to me, that's probably the only presidential return that I do personally ascribe, the negative return to Nixon. Now, if you look at this chart, it shows both of his elections as having positive returns in the years following, and that's true. But of course, who does this leave out? Well, it leaves out Gerald Ford. And about the 9 months before Nixon's resignation were extremely negative months in the stock market. And that negative slide turned around the week after Nixon resigned. Ford presided over a very positive stock market. So if we're looking for one story of presidential activity that created really negative results for investors in what I'll call the short to medium term, 1 month to a year to maybe 18 months, I think the Nixon administration is it. But largely, if we look at the big pattern here, again, what do we see? Well, you get very different returns, very different things happening in the economy, but generally they tend to be positive. Most presidents preside. It may be highly volatile, it may be less volatile, it may be more controversial, it may be less controversial, but they usually preside over positive returns for investors. Now, of course, what most people ask at this juncture is, well, that's great. That's a measure of 4 years. But I would like to avoid especially negative returns in a single year or even a single month. What if we focus more on the periods right around the election? Well, we can look at election years, the year of the election and the year that follows, because very often the conventional wisdom is the year of an election involves extra volatility, extra uncertainty, extra risk. After all, we're all often politically discussing a lot of changes to management of the country, management of the economy, management of our international affairs, which all, of course, can connect to the performance of capital markets over time. But there is no strong signal that we can see, that Dimensional sees, to build an investment strategy around. Nothing that says that all of that extra media attention, say in the election year, which we can see in this chart as the gray bar. So for each election, starting with Hoover versus Smith at the bottom and going up to the last election, that gray bar represents the return in the year of the election. The green bar represents the following year's election. So sometimes we can see a little bit of a signal that maybe after the election year, there's relief and maybe more certainty and more clarity. So markets go up. But it's not always the case. We can find almost just as many situations where the following year is actually a negative year. So Dimensional sees no strong signal around which we would want to build an investment thesis, regardless of who we expect to win an election. And again, I don't have to go back very far. I'm sure you can all remember to find an election where we had an unexpected electoral result. I would say 2016, against most of the conventional wisdom, certainly qualifies at the ballot box level and absolutely qualifies, I would say, at the stock market level, the stock market delivering a really unusual positive return in just the weeks following the election. And that will be the next data set that I share with you. Let's put aside years and let us just look at those weeks. Let's look at the election month. Surely the election month shows us a really strong signal, either again, relief that the election is over, or when maybe one party that's perceived to be more business friendly or more markets friendly takes over. Doesn't that generate an automatic improvement in markets? And the long-term answer is it does not. So what we're looking at here is a histogram. So I'm assessing the monthly return, a single month, 20 days more or less, in the stock market as defined by the S&P 500, going all the way back into our data set. And of course, most of those months were not election months, so those are colored gray. Very few election months, of course, just every 4 years, that November's return. Do we see a strong signal that we can build a strategy around? Well, I will credit these two really positive months. Those were both Republican elections. Maybe that's something. And yes, the worst month is a Democratic month. But there's no strong signal in the middle of this distribution that would suggest there's something special we need to do. Again, either based on who we think is going to take over the Oval Office or just the fact that the election is over. You can see there's just as many positive returns in that month as negative returns. The distribution is very noisy, no strong signal. Now, of course, we talked a little bit about the president, but of course, it's Congress that really controls the purse strings. You could argue that the president has a bully pulpit. The president certainly can make arguments about the economy and public affairs in the stock market, but to a large degree, it's Congress that directly controls the ability to tax, the ability to spend, and a lot of public policy that drives GDP, economic growth or contraction, and in turn the stock market. So what about Congress? So let's put the presidential elections aside and look at the off-year elections. Gives us another kind of cross-section into congressional results. Again, we see no strong signal. Again, most of those months are not election months, but those that are, I don't really see a distribution here that very clearly says I should run to cash and hide, or I should lever myself up and take advantage of some uncertainty. It simply doesn't show up in the market that way. Now, this I think is a useful time to pause and ask ourselves, why is it that the market doesn't seem to provide a really dramatic reaction in a systematic way that is over and over again, something that we believe we can reliably harness? Well, of course, a big part of what the market is doing, that daily auction, and it's an argument, if you will, between all possible investors, you could argue, around the world. Big part of what the market is doing is it is pricing in, it is reflecting all future opinion. I would say both informed and uninformed opinions, both correct and incorrect opinions, pricing all of that in the form, again, of a sum total auction on the value of all of these positions going forward. And by the way, every investor's definition of what that time frame is, how far forward am I looking, is probably different. So the net result, Dimensional's view, is that that competitive market is so good at pricing assets. It is actually our best source, our best alternative, better than any other alternative. Any single investor, any single active asset manager that has a forecast, any single government or central bank, it is the best repository for a picture of what is going to happen going forward. Put another way, Dimensional believes that those prices that stock markets identify can be put to use to give us a sense of what to expect going forward. That's really what gives us that choice as investors to ignore what is happening in the news. I call it a choice because it is a philosophical point of view. You may choose, and some people do, not to agree with that. You might choose to say, no, I want to take advantage of news events. I want to take advantage of good or bad news. I want to take advantage of the uncertainty around the election and speculate to that point. But our point of view is the alternative, if you're using prices that markets produce every day, is you can allow the market to price in all of that uncertainty and you don't have to do it yourself. That to me is a powerful choice. Now, what I want to do, I want to show you one more piece of data before we switch gears and talk a little bit about psychology. And I'm listening if Allison has any questions, especially on these data as we've looked at them. One more view, again, on Congress control, because I think it's a pretty powerful piece of conventional wisdom often that, kind of divided government means that government usually doesn't move strongly in either direction. And I think it's sort of, again, conventional wisdom that lack of movement creates more reliable circumstances, more stasis around which businesses can plan and grow and thrive. And there might be a lot of wisdom to that. In fact, I want to argue that what we've seen politically, especially in the last 20 years, has been a movement more largely toward that kind of, if you want to view it negatively, gridlock, where control of the halves of Congress, the Senate and the House, is often divided. Often that does slow the progress of new legislation, new changes, again, either on the policy side, on the tax side, what have you. There's probably something to that. But the other reason I want to share this data with you is I think that these views, in fact, these colors, the red and blue, in fact, each of us, our own political engagement, whether it fits into traditional liberal or conservative buckets or not, I think that strongly colors how we view the economy and how we view markets. And I want to share a little evidence to that effect. So again, this is all the data I have on markets, simply to say that markets generally reward us. Markets are messy and dynamic. Markets are constantly changing, and there's no simple and strong signal of political control. In fact, I would argue we shouldn't expect one, because again, both of these forces are dynamic. Often what we see is as soon as one party, if a party takes over control of both the White House and Congress, usually there's a little bit of change from that party, and that party is immediately kicked out of control of Congress or the presidency. Usually, again, that pendulum swing reduces the amount of radical political change that our country is exposed to at a federal level over time. And similarly, I want to argue that price mechanism in markets reduces the surprises that we didn't expect. Reduces, does not eliminate, and I don't have to remind you, of course, if you've been around, if you've been investing in 2020, and I'm sure you have been, we can think of some cases where a surprise did show up and markets responded very, very strongly in the short term. But of course, the punchline to that story, at least capital markets thus far in 2020, maybe gives us an interesting lesson in how or when we should respond, but we'll come back to that. So again, that idea of our political perspective, how does that color our opinion of the nuts and bolts, the dollars and cents of capital markets and our investments? Well, I want to share some data from the Pew Center for Research. Now, this has been a study they've conducted among many of their, again, kind of apolitical studies about how people view the economy, specifically people with extraordinary political opinions. And here what we're looking at, again, are those who have a Republican point of view or lean Republican versus those who have a more Democratic or Democrat point of view, lean Democrat. I'm not really interested in the overall sentiment, which is probably not going to surprise you looking at the last 20 years. What I'm interested in is the spread, the difference between that sentiment, how dramatic it can be and how quickly it can change place and when it changes place. So of course, we're going to start here in the year 2000. You may all remember that as an actually unprecedented election settled in the Supreme Court, Bush and Gore. And of course, that was a time when the dot-com boom was on, and it was just the few months following where the dot-com bubble burst. And we can see, if we look at that gray line, the sum total of perspective, everyone they polled was suddenly getting very sour on the economy not doing as well. Fewer and fewer people saying the economy is good or excellent. But look at that amazing division between Republicans and Democrats. Republicans being in power, it seems like the natural human nature is that maybe they're looking at different data or interpreting it in a more optimistic way or trusting those in power, whatever it may be, they have a much more optimistic view than those who are out of power, the Democrats. And look how quickly it changes in 2008. Again, another period, of course, of extraordinary economic tumult. But again, those positions, almost as soon as the election occurs, invert. Suddenly, Democrats are more optimistic, Republicans far more pessimistic. And that pattern holds until, yes, you guessed it, the 2016 election, where again, that inversion becomes even more violent. Despite that very slow and very painful climb out of 2008 and 2009, the perspectives around that climb, which you look at the objective data, did not dramatically change overnight with the Trump administration. They did improve, but did not dramatically turn around. We can see how incredibly different one's political perspective, apparently, on average, colors economic perspective. Why is this? Well, I think a big part of the influence is, of course, our media consumption, each of our media diets, and each of you are going to have a unique media diet. And I am not going to lecture you on what media you should read or follow or not. I love this cover of Fortune magazine because I do think, and this is from 2017, if anything, it's become more prescient, I think, and more powerful in the year 2020, where again, our political biases, our political priors often strongly influence how we interpret the behavior of our leaders and how we interpret what you would think is relatively objective data on the economy and on capital markets. The one soapbox statement that I will make here, after years of thinking about the media, something which I think is uncontroversial to say, I believe it's really healthy for all of us to pay for some of the media we consume. I would argue that a lot of the news we get online is free. That is, we don't pay any money for it. We may pay in time or attention. I would also argue that a lot of the news we get on TV, we don't directly pay for. I think it's really good sort of media hygienics, whatever your political engagement, to have some journalism that you directly pay for, where the journalists and that media source are working directly for you, not just working for advertisers. Because I want to argue, if media is only in the business of catering to advertisers, you are not reading the product, you are the product. And I think there's a lot of evidence to suggest that regardless of political orientation, those media tend to do the best that they can to retain your attention by constantly triggering stressful emotional responses, especially in election years. Why election years? Well, of course, we know that we're all running up to an evening or a day or a couple of days, however long it takes, to find out if there's a dramatic change in political engagement. And I think there's a really important reason why that is. And this is the last piece of evidence I want to share with you before we kind of switch gears or get into my conclusion, and hopefully we can start a good Q&A. And that's a study from Daniel Gilbert et al. Now, Daniel Gilbert is a professor of psychology at Harvard University. Now, what Gilbert specializes in is economic decision-making over lifespans. He surveys how people make decisions, consumption decisions, investment decisions over long periods of time, 40, 50, 60 years. And a couple of years ago, he published this article in the journal Science called The End of History Illusion, which I think you don't have to read the journal article to get, I think, this really powerful takeaway. It's all about the distortions, Gilbert argues, that we all have within us about how we think about the past and how we think about the future. Very briefly, I'll summarize this and hit our conclusion. Gilbert's argument is there's a magical age, a special age at which, when we look to the past, we agree that we've changed a lot. Our preferences have changed, what we like to eat, music we like, our friends we like, maybe even our political opinions have evolved over time, sometimes rapidly. But when we look forward into the future, our general thesis is that we are completed projects. We're not going to change our political opinions. We're not going to change what we like to have for lunch. We're not going to change what we like to watch on TV. And Gilbert's argument is that magical age is every age. He finds that it is true at 20, it's true at 40, it's true at 60, it's true at 80. That we're very good at looking at the past and seeing how not only have we changed, but society has changed. But he argues it's very difficult for us to look forward and acknowledge that the same rate of change is going to continue. That's what he means by the end of history. He's identified this bias that, at least statistically, we have within us, where it's difficult for us to accept or assess change. Now, that can be change on a personal level, personal preferences, but he argues it can also be change at a societal or governmental or political level. So if you have elevated stress or concern during an election year, I was heartened to see that most of you actually have a positive point of view. Most of you don't expect your returns to immediately evaporate, even though you don't like the experience of the election period. If you do struggle with that, I think Gilbert's insight here is really powerful. That, again, there's a way that it's difficult for us to kind of think about the future and appreciate that even though change will occur, and we're harnessing uncertainty, especially as investors, I want to argue that definitionally, we are being compensated for bearing uncertainty. To me, that is sort of the definition of the act that we take when we take on the share of a bond whose value can change, or the share of a company whose value can change. We are embracing uncertainty because someone else wanted to sell that position on uncertainty. Gilbert kind of gives us permission to recognize that as human beings, we're not great at thinking through what those risks and returns look like. That's why I want to argue we have an investment plan. That's the value of an independent advisor. The number one way that Dimensional works with individual investors is through an independent advisor where, again, they have objectivity, they have no conflicts of interest, and they can advise you. And it sounds really simple, but to me, that central benefit of an advisor is objectivity. It is literally not their money. My experience with my wealth and the people I know really well, our wealth, in fact, I would argue the more we have of it, the more it can be freighted with family goals, with personal goals, with emotional goals. And those can be really difficult to divorce either from political risk, political engagement, or what happens in capital markets. So let me sum up for you. This was the kind of what the data showed us. There's no systematic pattern. In fact, we shouldn't expect a systematic pattern with a well-functioning stock and bond market. In general, there's always been, or I should say, we have realized a positive return on that uncertainty, even when in the short term and the medium term, sometimes we bear incredibly negative results. And again, we don't have to go back far in 2020 to see a period when that happened. And then finally, that again, election outcomes are largely embedded in the prices that markets have. Doesn't mean that markets are always perfect. Doesn't mean that you're not going to occasionally get a surprise bump or a surprise drop, like we saw in 2016, a surprise bump in that case. Doesn't eliminate those uncertainties. But again, it's a choice we can take philosophically to put aside the will to respond to that and simply work a dynamic investment plan that is based on all of these changes, tapping in to what markets do really well. The last idea I will leave with you, and then I'd love to hear from Allison if there are questions, and I believe there are already a couple. So what can we do? Well, again, we can work that investment plan that's kind of detailed here, all of those basics, an asset allocation, being thoughtful about turnover, taxes and costs, diversifying where we think that compensates us. I will tack on one more bullet point for election season, and that is that you can do something to engage your political opinions. Of course, you should vote, or I think most of us should vote, but you can also do something else. And I think some people, if they want to fiddle with their wealth and they want to connect their wealth to their political engagement, I would encourage them to write a check. That may be too late this year, but of course, your political voice can be strongly amplified through money. And so that is an option for all of us. And I would argue, before you start to fiddle with your sectoral allocation or your cash allocation, before you start to speculate on what kind of month we're going to get in those distributions that we saw, you consider maybe, if you want to connect your money to politics, you support the political voices and political action that is important to you. And then, of course, last but not least, if you're really feeling pessimistic about where you live, the conditions in which you live, the tax basis that you have to put up with, voting with your feet is a powerful way to send a signal, usually at a city and state level, that you don't like what you're having to put up with. And I would say that's sort of the last resort for all of us. But we do have ways that we can put our political opinion into action without, again, entangling it with what we do in public capital markets. So with that, Allison, I'd love to hear if there are any questions or any other directions we can go in the time we have left.
Christian, thank you. Yeah, this was really helpful. And we did have one question come in. I know all the data you went through at the beginning was related to the S&P 500. Do you have any data on how the international markets have been impacted by elections in the past, or Democrats, Republicans in office, how that affects global stocks?
That's a great question. So I don't have easy data. Well, I should say I don't have data on that for today. It's harder to disentangle that. It's harder to pull it apart. Let me share a couple of reasons why, which due to lack of data may at least be useful. Of course, when we think about our own political risk, our political engagement, the political risk that we have just living in a country, it's easier to look at that local market. But of course, what's a local market? After all, there's tons of capital. Reason is, where we see capitalism working well, it works well around the world. We see, again, that same positive return on investments, not just in the US, we see it around the world. I think the difficulty in looking at data is you're suddenly dealing with a much more complex math problem. You have more securities, more stocks and bonds, but you also have another 43 different territories, different countries to deal with. And of course, each of those countries have their own political risk. In fact, this is something I do like to point out to people who very often kind of forget the fact that if you are a global investor, you are also exposed to a lot of other governments that, put it bluntly, don't necessarily walk the same way the United States walks. You may be invested in governments that have a lot less capitalism, maybe way more socialist. In turn, you are probably invested in some territories that are way more capitalist than the United States. I love to point out this one data point, and again, this doesn't speak exactly to that risk of, I'd say, political control and international returns, but I'll share this one data point, which is hopefully satisfactory. So the Heritage Foundation has, what they call an economic freedom index, where they go out and they sort of have an objective measure for how much economic liberty is available in every territory, every country around the world, and they rate 240 different countries. And so, the highest score you can get is the most economic liberty, and the lowest score is the least economic liberty. And I'm guessing if you're paying attention, who got the lowest score. North Korea gets the lowest score according to the Heritage Foundation. But the United States is not number one. In fact, the United States is barely in the top 10. Number one answer is Singapore. And of course, the United States, I think, is around 8 or 9. And it's actually, I think they lost about a point last year. They update these numbers every year. But what I think is really interesting is the United States has been a great investment internationally in the last 20 years. It's had one of the highest returns just because the innovation and the success of some US companies, especially the FANG stocks, has really driven positive returns in the US that you just don't experience in other countries. But it has not been the number one returning country. That would be Denmark, which has a much lower freedom score than the United States, with a return even better than the US. So I guess what I'll leave you with is this idea that, we don't only invest where our, kind of political engagement happens. We're also frequently investing around the world, but we can use those prices in capital markets to guide the degree to which we should invest or how much to invest in those other countries where the political risk, I would argue, is higher. They tend to be smaller, more likely to change. And of course, we don't usually, unless we have, really special circumstances, vote in those other territories if they have democracy at all. And some of them, of course, do not. So there's a big variety of political experiences out there. And I would argue, to kind of bring it back to this notion of what are the risks we're compensated for as investors, part of the compensation of taking your capital out to those other 43 territories, whatever the number might be, is that you are bearing those risks of the currency risk, right? Because when you repatriate all of those returns or all of the dividends, you're probably going to put them back into US dollars. Most of us are consuming US dollars. So that's just one risk. And of course, you've got individual political risks in all of those countries. We don't have to go that far back, 25 years, to find a case where a relatively thriving emerging market essentially goes to zero and nationalizes stock, and investors lose almost everything on the dollar because that's the nature of political risk. And that's why most people, when they invest outside the United States, are going to do it in a very diversified way.
Okay, great. Thank you. And I know we have had a lot of questions. You mentioned socialism. A lot of concerns about the United States moving more towards socialism from capitalism. Thoughts on that?
Yeah, I think it's a very reasonable perspective. And again, let's go back to the Heritage Foundation. That's another reason I like that data, is it acknowledges that capitalism and socialism are not binary states, right? We don't, I would say 50 years ago, the world that I was born into, there was sort of a binary world, right? Where we had, the Soviet Union and we had the United States, and you pretty much, with a very few exceptions, you had to pick one. And if you were for free markets, you were free. And if you were for, true Soviet socialism or communism, which I would say is the strongest form of socialism, those binaries felt really powerful. And I think a lot of us, myself included, still kind of think in terms of those binaries. So I would say, if you are concerned about rising socialism, my perspective would be this. If we view that balance, again, you can see it if you look at the, excuse me, that economic freedom index, it is really a gradient. It is a combination of many, many different policies. The social safety net, how big is it? How expensive is it? To what degree does it put national debt into peril? Or do you have zero safety net? Do you have a situation where you kind of have pure capitalism, where failure is really, really dangerous to entrepreneurs or to if there's a wide array of experiences there. So when I think about that situation in the United States, if I'm being, if I'm trying to control the degree to which I'm kind of crashing together, again, my political opinion versus my opinion about capital markets, I try to remember that that pendulum is very, very heavy. It is a very heavy pendulum. Again, I think the genius of the Constitution is that it is designed to make decisions relatively slowly. We all know, and I'm sure this is evidence people have heard, people vote in elections, that's true, but we all know that by design, it's intended to be relatively lowercase c, conservative. We know that to some degree land votes, to some degree money votes. I think that keeps political change from swinging too much. I think that was true in 1788. I think it's true in 1988. I think it's true today. So when people talk about more socialism, the way I think of that is that, okay, you're moving a few ticks down in something like that Heritage Society metric. You're not suddenly shifting to what it was like to live in the Soviet Union in 1965. That's my perspective. People can reasonably disagree with that perspective. But when I try to be honest with myself, again, what I view is that usually when a party, let's take a scenario where the Democrats get control of both chambers of the legislature and the White House, usually that party, whatever party it is, when they're in control, they have a chance to enact one or two big pieces of legislation before the pendulum swings back again. They lose control of the legislation or the White House, and the process continues again. So I'm not going to claim that if Biden is elected, or if the Senate goes under Democratic control or under tie, which would effectively be Democratic control, that we won't have maybe more socialist policy. But I think there's just a reasonable limit on how far that pendulum swings at any one time. And this is the world where we're getting into my personal opinion, Christian's opinion, not dimensional, to be very clear. My perspective is, by design, that pendulum does not move rapidly. And that means, as an investor, I do not have to throw all my money into a suitcase and go to Singapore, #1 on the Freedom Index. I think we have, again, that choice as investors. Now, all of you on this call, you may not agree with me. You may think that that political risk is actually much higher, much more acute, and does require response. Let me share with you one more perspective, if I can, because I talked about, again, capital markets and our political engagement. Well, there is an overlap, or I should say total wealth and political engagement. There is an overlap. And to me, that overlap, especially if you're on the call and you own and operate your own closely held business, if you are a highly compensated professional, some of those professions have real exposure to political change, way more dramatic than the stock market does. If you have that kind of human capital risk, there may be choices that you have to make, changes that you have to make. You may have to speculate about what kind of change occurs. But my perspective is that change is usually slow. That change is usually, again, moves in very slow increments, usually. And I think that gives us permission as capital investors not to run for the hills, but again, inside an investment plan that's set up to reasonably achieve what we want over time, to not have to do something dramatic. I think there's a big opportunity cost. There's a big sort of unseen cost in doing something like going to cash and riding out, say, a Democratic controlled administration and Congress. You take those 2 years off, and again, that's not your team, right? So, you're probably more inclined to view things from a conservative point of view. You might feel good to not be exposed to that uncertainty. But at the end of those 2 years, if the market has not truly suffered, you have lost money on that trade. Emotionally, you may have felt better, but you've paid the price. And let me use one more kind of example to amplify that idea. I talked with so many people in March about what was happening in the stock market related to something which I regard as relatively apolitical, that is the coronavirus. And some people were saying, this is just too much for me. It's too volatile. It's real simple. I want to go to half cash and stay in half cash until until this virus is dealt with, until we have a cure, or until we have something that inoculates people, until we return to real life. I don't want capital risk. And of course, we've seen how that's played out. The market did drop very quickly, arterially, in fact. The market suddenly recovered. I think most people have come to peace with why that happened the way it did. Not every business was kind of kicked in the shins like our favorite bar or favorite restaurant was, unfortunately, or favorite sports team. But now, if people are half in cash and waiting for the markets to come back to that level before we have kind of immunity to this vaccine, I don't think we're coming back there. Again, that's my personal speculation. And so those folks are going to have to take a really big hit in their total return over the lifetime of their investments. It may have been worth it because they could sit out that volatility they didn't like. And again, that comes back to me, that choice we have as investors. If you want to really overlap your politics and your market exposure, you can do it, and it might feel good. But if you're not disciplined about how you get back in, and if markets don't go the way that you think they're going to go, and regardless of your political orientation, I hope I shared with you examples that showed even when your team is on the bench, if you will, there's still a positive return on your capital. That's that opportunity cost that I'm talking about. That can really punish you in the long term, even if emotionally on the day it feels good.
Okay, great. And Christian, I like how you touched on specific businesses potentially having more political concerns than other.
Sure.
So in that same vein, do you see specific global opportunities or market segments that would be influenced by either outcome of the US elections, both executive and Congress?
Yeah, so that's a great question. So, I think this does speak to, especially in hindsight, we can find cases where, one president is elected, they have one perspective with, say, one industry, with tariff policy, with a trade war with China. You guys don't all know what I'm talking about. That's what we've been hearing about these last 3.5 years. And if you're like me and you're heavily invested in both the US and the global economy, you want those trade wars to be resolved, hopefully in a way that's to the satisfaction of the US on a political level, but you want them to be resolved as quickly as possible so you can get back to having hopefully reliable returns. But in that kind of an event where there's deep uncertainty about, how strong a negotiator will Trump be, to what degree will he risk, really problematic stuff at home to prosecute a trade war like that, that does produce, especially in hindsight, opportunities where we can say, hey, if we had been in this sector, in this country, ahead of this political change, we could have made a killing. And I mean, so when I talk about no one controls markets, I'm not suggesting that especially someone who can, again, enact trade policy like the president very strongly can, although again, trade treaties do go through Congress eventually, those can produce opportunities that in hindsight look like they are exploitable. And again, if we see that before it happens and we choose to speculate and we're right, yes, that can be a lot of sudden wealth really, really quickly. But to me, that is taking on a whole set of risks that most of us simply don't want to do, especially if we don't work in that industry, don't have exposure to that industry. The more conservative, lowercase c, perspective that I harbor is, again, if you have risks in an industry, you're probably going to really reflect those in your business, the capital structure, the risks you take on, how expansive or conservative you are in running your business. I would say it's probably more important to do it there rather than speculating on how's that going to show up in capital markets over 1 or 2 or 3 years. Because no matter what our perspective is in capital markets, whatever thesis we have about how political change will result in winners and losers, and that does often happen, we can certainly look at cases where in the short term, say a couple of months, where the president's speech has resulted in increases or drops of public companies. We can see examples of that, but they usually return to long-term averages really quickly. So if we are investors for the long haul, and I think most of us are, putting our assets to work for goals that we're achieving over decades and not, kind of months or quarters, I think we can safely choose to ignore that in our public investments. Doesn't mean we have to. It's a choice that we can make, but to my mind, it's a way of isolating what happens in politics versus what happens in our investment accounts.
Okay, great. And I know we probably know the answer to this question, but it's one we're getting a lot from clients, so I want to pose it. There's a lot of concern about when we will know the outcome of this election, that potentially it could be a few months. And would it be better to hold some additional cash on the sidelines until we know who wins the election?
Yeah, it's a great question. I think, I think I'm not going to ascribe blame for that perspective, but let's all stipulate, let's all agree that it is worth being more concerned about an election that's not called, on cable TV at, 10 o'clock at night or whatever. Because of course, we don't have to go back that far to see a case just like that. And that's Florida in 2000 with Bush and Gore. And that was, a really controversial and kind of amazing thing to witness. I remember it in detail. I was in college at the time. I didn't really have 2 nickels to rub together, so I wasn't invested at that time. But I did go back and, thinking about this year, I looked at market performance over that time, and markets were volatile, but it was nothing deeply arterial and really taxing like we might think. And again, I think that's a recognition at the end of the day that hopefully really cooler heads do prevail. I think the most extreme scenarios that you hear on any side of the spectrum, I think those are just that. I think those are ways of getting attention in the media, and I don't think it's necessary to, again, kind of go into the bomb shelter with all of your cash. Again, I would say reverse that. If that is your thesis, understand that there's a big opportunity cost to doing that. I would argue that those of us who stay invested, as long as we think all of those companies, as long as we think Tesla and Apple and Netflix are going to be in business in 6 months, I think they are. As long as we think that the Constitution and the federal government will not be dissolved, I'm willing to bet that they will stick around. I'm that optimistic. And as long as I have a long investment horizon, more than a couple of years, I don't think I need to respond to that risk. Now, let's say I'm going to buy a yacht on January 1st, and I've got a big set of equitized capital to buy that yacht, and it's perfectly the liability is perfectly matched. That is, I've got the capital today to buy that yacht. Probably not a lot of return in taking the risk of the next 3 months. That I would go to cash because of that specific liability, the specific way I'm going to use that capital. But in that time between when the ballots close and the uncertainty is hopefully resolved, and what is hopefully a anticlimactic, or from the worst case scenario perspective, capital investors will be strongly compensated for holding those positions. If those positions are discounted for a few days, eventually, assuming we get back to normal, and again, we're stipulating to that, I hope, we'll be compensated for that, meaning that we will get more in return for that risk. The notion that greater risks, especially if you harness them in a diversified way, get better return, that is baked into all the econometric evidence, that's baked into the academic evidence, that's what dimensional is, an exponent of that idea. So even in a period where there is uncertainty, we can expect to be compensated for that uncertainty. Again, we may have really specific goals, and that's where an advisor comes in, because an advisor can help you to define, is your idea of the risk and your definition of what that capital is doing for you so great that you do need to put it to the side? And if you and your advisor agree to do that, you should absolutely do it. I'm just saying that it's not free, because there is an opportunity cost there. And if you're not really disciplined in how you define that uncertainty being over, whether you measure it in capital markets or news headlines or something politically, it can really screw up an asset allocation, because again, you end up giving up a lot of return. And again, especially the periods of uncertainty is where return is earned. And again, I would advise people to look at March and April and May of 2020. Those who held on to their positions were compensated for what? For not liking the feeling of deep uncertainty about how bad is this, a public health crisis going to be to my investments? And even today, I would say that question is not fully answered. There's still uncertainties that we're all bearing as investors. What I would go back to maybe try to put a bow on it is, I feel like the media is really good at spotlighting what the risks are to your investments this time of year, or this time every 4 years. But those uncertainties are always present, right? There's always the possibility of something bad happening to a single company, a default happening to a bond, something happening at a very systemic level to an economy, even the United States economy. And that's part of why we see that positive return of capital, because we are bearing those uncertainties.
That's great. So one final question from clients here. Is this the same conversation that we have every 4 years, or are you seeing heightened investor concern for this election?
Here's what I would say. And, I've been in a position where, to a degree, I've been a spokesperson for Dimensional, really only through one other election, really only through 2016. But when I think back, to a lot of elections, I think when we're in the fever of that election, 2000 is another good example, especially how, the final decision, was resolved in that election. I do think people, again, they view today as the most intense thing ever. I think that can get a little overemphasized. But I will say that I do think just because I think like people say, the temperature of the political heat and the differences of opinions right now are very strong. And I think there's a lot of space between political opinions. It's not the only time that's happened in the history of the United States. We can see it in the 20th century, definitely see it in the 19th century, but capitalism still kept on chugging. But I do think it's a period where a lot of people are hoping that, the election kind of resolves some cultural conflict, even on a minor level. And so I think it's reasonable for people to say this election feels different. But what I would say, as we look at, what capital markets are doing, it doesn't really look different. People, the number one question people ask is, does the election dictate market results? And the answer is, it really doesn't, not statistically. However, market results often predict election results. So I think it's worth to kind of look at that stuff, but I don't see any reason why, this is really my personal opinion. I just don't see some kind of a risk here where, the country is on the verge of something, really dramatically problematic. And I'll say, I think the reason that is, again, why democracy and capitalism go well together. I think capitalism makes, this is really getting out on a limb here with my personal political philosophy, so you'll pardon me for saying this, but I think capitalism encourages people to make careful, safe decisions that benefit themselves. And I am a kind of a believer that if all of us pursue our self-interest in an orderly way where we have a reasonable rule of law, we've got contracts, we can make investments, we can invest in our families and our human capital, I think good things tend to happen even with the short-term volatility. So Allison, I'm rambling a little bit here because at the end of the day, I can't make a prediction, but I still feel like, it's kind of like Warren Buffett says, the U.S. is still a great investment. And I see nothing in the political noise to suggest that he's wrong.
That's great. Thank you, Christian. We really appreciate your insight. Thank you so much for joining us today. Any final words to leave us with?
No, I think like the rest of you, I'm definitely looking forward to March. I'm looking forward to March. I am looking forward to March 2021, but I'm looking forward to the election being over. And again, my hope is that I don't think it's really going to change capital markets. I don't think it's going to change our rate of return very much. We may encounter, new tax policy. There may be new stuff that we have to deal with our wealth. But I do think it'll just be nice to, move on to, the football playoffs or something like that. That's a little lighter.
Yes, something a little lighter. Well, thank you. And we just want to extend a big thank you to everyone who spent your time with us this afternoon. If we were not able to address your specific question, we will follow up with you later this week. You can also check out our blog and podcast for more information and articles to help you reach your financial goals. As always, feel free to reach out to us with any questions or concerns. And last but not least, I just want to echo Christian's sentiments and encourage all of you to get out and vote. Thanks a lot.